Have you ever thought about how much money you need to actually buy your first rental property or maybe even your next one? So, when new investors start thinking about this, they usually want to overestimate how much they need. And then what happens is it just stops them cold because they're like, I don't have that kind of money, right? Or on the other hand, they underestimate how much money they're going to need to buy that rental property, and then they find themselves kind of where they've dug themselves into a crisis, a financial hole, if you will. So it's not about how much money you have or don't have, it's how you're going to structure the deal. So in this video, I'm going to be talking about, yes, how much money you need, sources to get that money, but also it will depend on how much money you can structure the deal. So let's get going. So in 2026, we're going to be talking about all the different ways that you can come up with a down payment or any of the money, but it's really going to be about how you're going to structure your deal. And this is about mindset in terms of thinking about, I never thought of that before. Oh, I don't want you to stop and say, well, I don't have that kind of money. Where can I get it? That's what I really want you to think about. The real question is not how much do you need, but how is it structured? When people think about how much money they need, they just stop because most of the time you're told you need 15 to 20 to 25% to put down on an investment property before you can buy it. Well, most people don't have that kind of cash in their bank account when they're first starting out and buying rental property. You may have a great job, but maybe you have savings, but maybe you're thinking to yourself, well, do I want to use all that savings for a down payment? So the wrong question is how much. The right question is how can. And this is a key difference between being a true real estate investor and how to move your money forward to buy a property. So who am I? Well, my name is Nancy Wallace-Laabs, and I'm going to be guiding you through this today. I've been investing since 2006. I'm here in the Dallas-Fort Worth area. I am a licensed real estate broker, and you're ready to start taking that step. You can reach out anytime and call me at 469-430-9885, or you'll find all ways to contact me down in the description below. When we're talking about this, what we're saying is it's really a clarity problem, not a money problem. Money's involved and you have to be clear on it. You have to be clear about your goals, the numbers, the numbers, the numbers, because at the end of the day, that's all that matters. The money part will always come if you find a good deal. You just have to know where to look and what questions to ask. For today, what we're going to be focusing on is 4 cost categories that as a new investor, you may or may not be familiar with. Number 1, down payment is. You know that you have to have some money in the game. It's all dependent on the lender. Different lenders, depending on how you're structuring the loan. But for an investment property, it's typically anywhere from 10% all the way up to 25%. There's many things that impact the amount of down payment. Number 1, of course, is purchase price. Number 2 is equity. If you're buying the deal at a discount, how much equity is in the home. But number 3 is the condition of the property because, you can't just go get a traditional loan for a house that needs a lot of repairs. So there's all kinds of ways to come up with down payment. It's completely fine to shop lenders. It's also going to be based on credit, your credit score, and kind of your asset situation. And then the next category is closing costs. So, closing costs, and sometimes you don't find out about this until the day you're going to the closing table, meaning you're going to be signing on the dotted line to buy that property. A couple days before the closing, you'll get what's called a settlement statement. And that settlement statement says, how much money you're buying the house for, any other fees that you're being charged. There's a fee for filing the paperwork. There's the prepaids, which would be your insurance. There's property taxes proration. If there's an HOA, it just goes on and on. So you have to review that, but also know what you're looking at. Now, a lot of times when you're closing your first deal, that's maybe the first time that you've ever seen a settlement statement unless you've bought your own primary home. There's a lot of confusion about what should be on here, who should be paying for this. And, everything in real estate investing is negotiable. So a lot of times those items that are on there, you might be able to negotiate with the seller. Now you want to do that before you get to that final closing statement. And you also want to check it for errors because sometimes it's just humans doing their job. Sometimes they make mistakes on the closing statements. And then repairs and stabilization. So it could use a lot of repairs. I mean, you might be buying a house that, is going to be 20, 30, 40, $50,000 worth of repairs. But the thing is, you're going to know that before you get to the closing table. That is because that's part of the numbers. That's part of, is this a deal? When you're looking at the systems in terms of the AC unit, the foundation, the roof, you will already know that ahead of time. Don't wait until you get to the closing table to go, oh my gosh, I'm going to have, $20,000, $30,000 extra that I didn't know about. There should be no surprises. When you get that settlement statement, there shouldn't be any surprises. And then let's talk a little bit about cash reserves. So here's what I want you to remember about cash reserves. Cash reserves means that you have to have a plan for a contingency. If, for example, the property sits vacant, or even if you're flipping it and it's taking longer, how are you going to pay for the maintenance, utilities, insurance, ring cameras, alarm systems, whatever it is that you're having? How are you going to pay for that if the property is not generating any income? So on a rental, you may buy a property and takes maybe it'll take 30 days to get it all cleaned up and put a tenant in it. During that time, what is your plan for your cash reserves? Now, cash reserves can mean you have money socked away in the bank. It could be additional income above and beyond your paychecks. And so, really, an exaggerated example I want to give you is during COVID, what happened to a lot of landlords is that tenants did not have to pay rent because the things were just crazy. But the thing is, landlords couldn't evict people. The tenant could apply for rental assistance, but the rental assistance was paid directly to the tenant. And if the tenant did not pay their rent to the landlord could not evict them. So this was not a good thing for landlords, right? It goes to show some people were prepared and they could handle, because the mortgage companies weren't saying, oh, hey, landlord, you don't have to pay us. They were not saying that. So people had to come up with, okay, I have to, pay my mortgages and my property taxes and all of that. But the tenant, again, there was no recourse if your tenant wasn't paying. Some landlords were able to weather that, some were not. That's just kind of an extreme situation. Now, let's talk about down payment readiness, about down payment reality in 2026. And what does that really look like? So, right now, where we're at with lenders, interest rates are a little bit on the high side, but as an investor, they're not really that much higher than what I normally pay. So, as a real estate investor, interest rates don't impact me like they do if I was buying a personal home because I always pay a little bit more. What lenders are looking for right now is they want to have some sense that you're going to pay the loan back. They're looking at, they don't want to, get the property back. They're going to be looking at where is the down payment coming from. So maybe it's not in your bank account. Maybe you're going in with a partner. They want to know where is that going to come from, and you have to show documentation of that. And then based on where people get it wrong, I think, is that they get stuck on, well, I don't have 15 or 20 or 25% to put down on a rental property. And again, I go back to, if you find the deal, you could call somebody like me and I can help you find the money. So you can partner with people to help you find the money. So if it's a good deal, there's hard money lenders, there's private money lenders, not just your traditional go to the bank and get a loan. That's what I'm saying about the whole structuring of the finances, is that you can go outside of what everybody would think of as the norm. And once you start thinking that way, then that kind of opens up a whole lot of doors for you to start your investing journey. Now, let's talk about closing costs, the line item that people forget. So, number one, most lenders have what they call an origination fee, or you might hear it called the points. And this is the cost of borrowing the money from the lender. It's not the interest rate. It's on top of the interest rate. It's okay for you to shop lenders. You can go and you can just call them up and find out what their rates are, what their points are. For example, a loan origination fee. So if you're borrowing $200,000 and the lender charges 1 point, or that's 1%, so it will cost you $2,000 to borrow that money. So that's on top of what you're already borrowing. And that'll be on the settlement statement. Now, if your lender charges 2%, or you'll hear about buy downs. So these are all things that would be on the settlement statement. And then you're going to have title and escrow charges. So the title company, there's a title policy. And again, you can negotiate for the seller to pay for that. And usually the title policy is 1% of the cost of the home. So if the home is 200,000, usually the title policy is right around $2,000 as well. But people kind of forget about that. Or if they've never bought an investment property, they have no idea that they are going to be socked with that amount. And then escrow is just the things that are going to be put in escrow. So a good example for buy and hold properties, let's say that you're buying a property with a tenant already in it. So the current seller, the current landlord, collected a security deposit along the way. And so it's important to get that security deposit on the line item, that you get credit for that security deposit that they collected, so that that shows up on, and you have documentation that you have it, right? You need to make sure you do that. And then there might be things like the proration of property taxes. There might be an HOA. So this is where all the other fees come in, just a filing fee, filing it with the county, that kind of thing. And then there'll be prepaid items. And these are things that, you have to buy. Example, insurance. That's the one that really comes to mind. So most insurance companies require you to buy at least 1 year's worth of insurance. They're not going to let you buy a rental property and then go month to month. I'm paying your premiums. So they want to make sure that the property is insured. The lender's going to require that as well. And that will also be on the settlement statement. So repairs and stabilization. So stabilization just means you got to get it up to the standards to be able to rent it, right? So again, the repair, you are going to know that number up front. That is something that you use as a negotiation tool, so that you already know ahead of time what your repair cost is, and you have factored that in to make sure this is a deal or not a deal. And then you made for a rental property, you might have to upgrade, let's say, the smoke alarms. We already talked about changing the locks. You may have to repaint, put in carpet. Maybe there's some landscaping that needs to be done. So the thing is, these should not be surprises. These numbers should not be surprises on the settlement statement or in your factoring of whether this property makes a good investment property. Now, cash reserves, the reason I talk about it being non-negotiable, I'm not saying that you have to have the 50, 60, 100 grand in the bank. What I'm saying is you have to have a way to cover for contingencies, right? Unexpected repairs, unexpected vacancies. It is a good rule to have like 3 to 5 months of reserves in the bank, but you don't have to. So one of the things that I do on my rental properties is I do the loan. I want my principal and interest payment to be as low as possible. So I do not escrow my property taxes and insurance. I choose to pay those at the end of the year. Why do I do that? Well, then I can pocket my interest and principal on my mortgages. Let's just say it's $1,500. And I'm able to charge $2,000 for rent. So I'm keeping that $500 in my pocket. If I had my property taxes and insurance in there, then the amount would be, let's say it would be 2,000. But if I can take that $500 and I can stick it into an interest bearing account, I'm going to make a ton of money, but it's going to be where I can regulate it and I'm making money on my own money. So that's just one little way that I restructure. And if I do that year over year over year, then I'm building my cash reserves. And that's just one rental property. So reserves are not optional. You have to have some plan. Where are you going to get the money? That's what I want you to think about. It's the difference between having a setback and a crisis. Just the thing is, I'm not saying you need $50,000, $60,000 in the bank in order for you to purchase a rental property. What I'm saying is that you have to have the ability to cover those unforeseen circumstances where you have longer vacancies, you have an unexpected repair. Those are usually the two things that will get landlords. Now, what does this actually look like in real numbers? Now, not that you have to have, 90K in the bank or 60K in the bank. But just to give you an idea of, okay, if you're buying this rental property at this price, this is how much that you should have in reserves. This is how much you're going to be paying. And it just gives you kind of more a visual of those four categories that we went over, and to kind of help you in the mindset that you don't have to have all the money up front. And again, if you find the deal, then the money will follow. You just don't know where to ask and you don't know where to look. Now, ways to reduce the capital barrier. This is like my favorite part because now I've hopefully you're still with me. You're learning about this and you're not going, oh my gosh, Nancy, I do not have that kind of money. So to reduce the capital barrier, meaning reducing the amount that you bring to the table, there's a whole lot of things that you can do. So number one, market selection. I say this all the time. You have got to invest in places, especially when you're first starting out, that are affordable for you, that's not going to, stretch you to your limit. So, for example, if I'm looking in a market where the houses are 100 to 150,000. Now I'm talking about getting off market deals, between 100 and 150, which you can still do in 2026 if you know where to look, versus, buying a 250 to $300,000 house. So let's, for math, let's just take 150,000. So let's say I had to have a 10% um, down payment. My lender was, requiring that. So that means if I'm buying a property at 150,000, I only need $15,000 only. I still have to find the 15,000, but 15,000 compared to if I was buying a house for 250,000 and now I have to come up with $25,000. You want to look at different markets and where can you get basically the most bang for your buck. One of the things I have is I use a heat map and I can go into any zip code practically in the United States and I can look at what is the primary price point of a particular zip code and then I can target my marketing to that area. The other thing you could do is you can partner. You can partner with someone like me. I can help you find the money. I might even be your private money lender. The thing is that people don't realize that there's more to finding money than just going to one of the banks or your credit union and filling an application. There's so many more avenues that they're just not out there for you to know about, right? Because you're new and you're trying to learn all this about, well, how do I even tell if it's a deal or whatever? But if you find a property, then you will always find the money. The only thing that you don't really know right now is how to ask for it, where to look. That's really the only thing. And then you can always leverage some other assets that you have. I've known people who take out a home equity line of credit. That's what I did. I took out a home equity line of credit on my existing primary home and I went and bought a rental property. Once you buy one property, then you're able to leverage that equity. It builds on itself. The barrier most people find is just getting that first property, but that's why you're watching this, right? Let's just talk about the three, kind of like a decision tree or however you want to look at it. So number one, can you carry it? What do I mean? I mean, if something happens, you lose your job, whatever source of income you have just dries up. How will you maintain the mortgage? Number two, enough cash for the down payment plus reserves covered. Do you have that or do you have access? So it's again, not do you have it like in your piggy bank, but do you know somebody who has a piggy bank that you can get the money from? There's so many things that you can leverage, right? Your existing home, another rental property, maybe you have stocks, there's so a lot of things that you can look at to say, I've known people who got a pretty good chunk of change on their tax return and they used that money and they went and bought an investment property. Yes, it's that easy. The hardest part is finding the deal that you can do that with. But when you have clarity around how to structure the money, it just makes investing, number one, it makes it a lot more fun because now it takes off the burden of, oh my gosh, I have to have so much money, I can't do it. It takes away the barrier so that you can get into real estate investing. So you have a checklist, you calculate on the four cost categories. So now you just walk it through your checklist of the four cost categories that we reviewed. You look at how could you handle a 6-month contingency? Where would you get that cash from? What market are you going to look at that has a great price point that you can get into easily? And what are those three questions that you're going to ask yourself in terms of, are you ready? And those are the things that you have to think about. And when you start shaping that as a framework, then that helps you become clearer. When you become clearer and you have clarity, then you have less hesitation and you're able to take action. Now, you may already be sitting on a gold mine of leads and deals that you don't even know about because you never learned where to look for them. So Kelsey and I put together a guide called Find the Deals That You're Already Missing, and it's free. The link is in the description below, but it's going to help you find hidden opportunities. And the reason I really stress on off market properties is number one, you don't have a bunch of other investors beating down all these sellers' doors. We will help you evaluate the deal. And once you start building this, we call a lead list, then we're going to show you through this guide some simple ways to turn those leads and convert them into, your next deal. So if you're ready to build the strategy, here's a few things that you can do. So number one, you can book a call with me directly by calling me at 469-430-9885. Happy to talk to you. Drop me a comment, right? All of my contact information is down in the description below. Download our free guide that'll get you started. And remember, you can do this. It's all about getting ready, becoming clear. And you might want to check out my video, Dallas versus Fort Worth, because I really dive into how do I look at markets? Like, how did I determine this market was better? What were the criteria that I looked at? And I think even if you don't live in the Dallas Fort Worth area, you'll be able to take that into your own market with those same kinds of criteria that I use. So thanks again for staying around, and we'll see you in the next video.